Kevin Wadsworth, Twitter handle at North Star Charts, joins us today to talk about the probabilities of Bitcoin, gold, silver, and the US dollar on this week's episode of Metal Money. I'm your host, Patrick Vieira. Kevin Wadsworth, welcome to Metal Money. How are you doing?
Hi, Patrick. Thank you very much for asking me on. How are you?
I'm doing great. Glad you had some time to spend with us. Want to talk a little bit about gold, silver, Bitcoin, and US dollar. People are very interested in those things. Got to ask you straight away, right at the top, how does one make the leap from meteorology, where you're giving us the probability of the weather, to now giving us the probability of price action with the charts that you create?
Sounds crazy, doesn't it? But you'll be surprised. It's there's a lot of similarities, and if you think about how rain falls from the sky, as a weather forecaster, I've spent my career trying to predict how rain is going to fall from the sky and where the rain is going to go and where the rain showers and the thunderstorms. And for all of that to happen, you have to have a bubble of air, and the bubble of air has to rise. And for that bubble of air to rise and cool and form rain clouds, you need the atmosphere around it to support that bubble to rise up. And it's exactly the same with a share price. You need that share price of that company to rise up, and it will do if the atmosphere around it supports that rising process. So all of the considerations that we take into account in meteorology, all the things that we look at in the atmosphere, it's all a process of evidence gathering. We gather the evidence and we work out, is that bubble of air going to rise? And if it rises, is it going to cool enough? And if it cools enough, is there enough moisture in the air to form a cloud? And then can that cloud form a shower? It's exactly the same with rising share prices. You have to consider all of the atmosphere around, I say atmosphere, I mean all of the conditions around that share price, and you work on the assumption that the company is a good company and it's well run, and the technical analysis does the rest. So all the technical charts provide that weight of evidence, and that's how we forecast.
Oh, great analogy. Makes perfect sense to me. But Kevin, I want to go back in time just a little bit where you had said in October of last year that gold would be dipping below 1750, and it actually did in March of 2021, just a few months after. I got to ask, what led you to make that very unpopular yet very correct call?
Yeah, it really wasn't anything particularly clever on my part, I don't think. I mean, you just had to look at how gold moved during that 6-month period, and it really became very, very stretched away from its moving averages, and a little bit like that bubble of air that I was talking about rising up through the atmosphere. If it rises too quickly, too far, too fast, it'll cool down and start to descend and come back down again. It kind of hits the top. A bubble of air will hit the top of the atmosphere, and it gets pushed back down. And so fundamentally, when you're looking at something rising that quickly, you instantly start asking yourself, okay, then it's had a really good run, months of rising. Now we've got to start looking for some signals, some signs that this is going to consolidate, or even worse, pull back significantly. And the chart patterns that have been forming at the time, the big picture chart patterns, for anyone that follows me on Twitter will be aware that I'm a big fan of spotting the arc basing formation patterns that occur across all of the markets. It happens with the US dollar, it happens with gold and silver and individual stocks. And we had a huge basing formation in gold, and by just studying that formation, it's very clear to me that the natural resting place for the pullback would be actually on the top portion of that arc, which was anywhere between, I suppose you could say, $1,700 and $1,800. So it was that kind of range that I was looking at. As you say, it wasn't very popular at the time when gold was soaring above $2,000, but you can't just keep drawing arrows on a chart that point from the bottom left to the top right. You have to keep considering and taking a step back and looking at where we may see these consolidations. And of course, that's what's happened.
You recently also saw silver breaking through the $27 price range. Do you still see silver hitting that $27 price point fairly soon?
Yes, absolutely, Patrick. I see silver moving quite rapidly through that price point. It's been surprising in a way that it's been held back so long. There are so many factors in silver's favour, but it has been holding quite steadily when you look at how gold prices has dropped, and silver's been, to my mind at least, quite resilient to hold in that sort of 25 to $26 range for quite a long period of time. It obviously got pushed down lower, but it was quick to come back up again. And when you actually take a step back and look at the silver chart, it's been performing pretty well. Now we're getting towards that $27 to $30 range, and I think once we push through $30, which I expect to take place in the next probably 2 or 3 weeks, in fact, we'll rise quite rapidly, in my view, towards that $40 to $45 area. In fact, the chart patterns that I've been following and posting on Twitter have measured moves that take silver up to around about the $45 mark. Of course, we've got that psychological and historical figure of $50 very close to that level. So I'd expect that to be tested. But in the period of time that it takes to get to that level, it's going to take us again through, I think, to the period sort of around July, August time, and that is likely to be a culmination of factors there leading to a high likelihood of a large drop. It's going to take closer analysis nearer the time as to whether gold and silver break through those sort of levels and continue to stage some sort of ongoing rally. But other things going on in other markets lead me to think that probably won't be the case. We have cyclical behaviors in gold and silver, and there's an 8-year cycle low occurring in gold in 2023, possibly into 2024. So we're expecting gold to move down sharply, and silver will no doubt follow along.
Are we going to see a repeat of what we saw back in 2011, do you think?
Yeah, 8-year cycle lows can be quite brutal. And in fact, 2008 was an 8-year cycle low for gold. So the lows occurred 2000, 2008, 2016. So 2024, possibly a little bit early in 2023, is that kind of time window, that time period. Just how violent the drop is depends on what else is going on in the world around us. We only need to look at what happened when COVID-19 sort of spread around the planet and what it did to the markets. So if something coincides with that 8-year cycle low, then it can be pretty horrific. That remains to be seen, but we'll have to monitor support levels nearer the time. But I will probably be taking profits off the table and probably closing some positions as we move into that period around July, August.
So you see that window opening and closing in a fairly short amount of time.
Yeah. So the window's opening now. It'll be closing July, August sort of time, perhaps into Labor Day in the United States, which I think is early September. That'll be pushing it probably to the limit. I wouldn't want to be taking too many chances beyond that, so I'll be turning defensive at that point.
Okay, let's hope for a sharp uptick at least. Get to see that. Kevin, with all the news, and we kind of touched on this, all the news of stimulus and money printing, geopolitical tensions, inflation, green technology, where we're looking at silver, especially in things like solar panels. Why aren't we, or why haven't we seen these two metals, particularly silver, really push up and hold their prices?
Combination of factors, really. I'll be honest with you, Patrick. I spend very little time sort of thinking and worrying about what the reasons are out there in the real world that are causing these issues, and I follow the charts and let the charts speak for themselves. So if a chart tells me that the price is breaking out and it has a measured move that's going to give us a 100% gain, which is what silver's saying at the moment, then I accept that without really digging too deeply into what might be causing that. But of course there are things that will be holding the metals back. It could be manipulation of some form or another. It could be the bullion banks trying to sort of ease themselves out of positions that they've got themselves into that are causing an issue, or it could be, for example, another market taking the limelight in at the moment. Of course, cryptocurrencies are also screaming towards a bull market climax, and I think a good deal of investment money is being channeled in that direction, particularly younger people. I guess it's probably the same around the world, but certainly where I live, young people are flocking to cryptocurrencies in their droves. It's typical bubble behavior, and perhaps that takes some of the investment capital away from precious metals. So yeah, it's a combination of things.
Another market taking the limelight is Bitcoin. And you had put out a tweet where you had said that Bitcoin had just defined a perfectly parallel channel. And in the next few weeks, if the previous cycle is a good guide, we will break through the upper resistance of 100,000 before reaching 200,000 to end this bull cycle. Now, the key phrase that caught my mind in that tweet was in a few weeks. So I'd like to ask you, when do you see this $100,000 level being reached and even breached?
Well, surprise, surprise, it's the same time window that we're going to see the precious metals reaching their peak as well. It's amazing how sometimes these things all coincide, but I'll be perfectly honest with you, it's very hard to give an exact precise time, but
Sure.
the charts that I've been drawing and publicizing for many, many months now point to a time window during I was going to say late summer, but of course your listeners will be all around the world, so summer is different in different parts of the world. But it's that period from June, July, August, particularly sort of July and August, and the arc formations that I've been drawing show a targeting period in that July, August. And possibly you could push the cryptocurrencies a little bit further into September, October, but for other reasons I think it'll probably peak before that. So I'm going to say July and August is my target area for in terms of timing.
USD has been slumping of sorts since late June of last year, 2020, when we saw the 50-day moving average on the DXY go below its 200-day moving average. Is a weakening dollar going to continue to be a trend?
There's a lot of debate around this at the moment because the dollar cycle it sort of displays three-year cycles, and there's quite a lot of debate around whether the 2018 to 2021 cycle is over yet. I'm not sort of going to go into the technicalities of it, but it's pretty crucial to see DXY break below 88.25 to confirm that 3-year cycle is going to continue to a lower low. From a technical point of view, if we see DXY move below 88.25, then it's confirming that we're heading much, much lower. My charts that I've been analysing for many years now have been pointing to DXY in the next 2 to 3 years dropping down below 70, probably into the mid 60s. So that has been my initial expectation for a number of years now, and that hasn't changed. But we always, as I said before, always have to monitor the charts and accept the fact that patterns could be different this time round. It could, things do sometimes happen that cause disruptions. COVID-19 was certainly disruption, and I suppose the economic fallout from COVID-19 is going to be a massive disruption. We're yet to see just how global economies are going to deal with the huge hangover of debt that's created. We've heard Joe Biden talking about a 4 trillion stimulus plan on top of all of the trillions that have been printed in the United States, and the amount of debt has been created by the United States in the last 12 to 18 months is greater than the amount of debt that was accumulated in the last several years. So the debt creation is now moving to an exponential phase. There's no denying that. It's a mathematical fact that debt is exponential now, particularly in the United States and certain other global economies. And once you get to that point, you're in a catch-22 situation. You can't raise rates. You raise rates, you kill the economy. Completely in a corner. Paul Volcker came along in the 1970s, put rates up to 10%. That killed the inflation problem. Can't do that now. Just can't be done. So I'm yet to hear anybody give me a reasonable explanation as to how we get out of this, except by inflating away the debt. And to inflate away, 30, 40 trillion of debt, is going to take one heck of an inflation rate.
Well, having said all that, Kevin, we are definitely going to have to keep in touch and get you back on the show real soon. Kevin Wadsworth at North Star Charts, we appreciate the time you've given us. And again, hope we can do this again real soon.
Thank you very much, Patrick.
There you go. Sunny skies for Bitcoin, gold, and silver, while the dollar is looking at some bad weather ahead. As always, leave your thoughts in the comment section below. And remember to keep it liquid, keep it real. And I'll see you on the next episode of Metal Money.